Bank runs have started. I'm your host, Steve Van Metre, and thanks for joining me today. One of the world's largest lenders is blaming social media for a liquidity crisis as customers pull billions. Let's over to Bloomberg, where we picked today's story up. With some Credit Suisse units breached liquidity rules amid outflows, banks saw elevated withdrawals at the start of this month, and it hasn't slowed yet. The withdrawals were triggered by negative press and social media coverage based on incorrect rumors, and made worse because the bank had limited its access to the debt markets in the week before it unveiled its restructuring plan. And now we kind of get an idea of who the Swiss National Bank was borrowing money from the Fed for. It's most likely was headed to Credit Suisse, who was limited in its access to the credit markets and needed funding as billions flowed out. Liquidity and funding ratios for the group as a whole have been maintained at all times, Credit Suisse said, so there's nothing here to worry about, or is there? These outflows have partially utilized liquidity buffers, so get this, they hit their liquidity buffers on withdrawals. It just tells you how bad of a situation Credit Suisse is at the group level and at the legal entity level, and we have fallen below certain legal entity level regulatory requirements. So there you see it. There's nothing wrong, but hey, we did hit some problems in our liquidity buffers, and all it was due to, as you're about to see, is customers pulling money out. It just goes to show how fragile Credit Suisse is and how potentially fragile a lot of other banks are that we'll eventually find out during the recession. Clients pulled 12.9 billion francs in assets in the third quarter, but it didn't stop there. The pace of withdrawals accelerated this month as speculation about the overall and how Credit Suisse might fund it heated up. And this is just a simple case of, consumers have gone through the financial crisis. They figured out real quick, not all banks are solvent. This time, consumers are afraid the government won't be able to stop any unwinding. The central banks are tapped out. And so what we're going to start to see is any negative press surrounding a bank is going to lead to capital outflows. And the fact that Credit Suisse can't handle it at this level is an ominous warning. The bank said it saw significantly higher withdrawals of cash deposits as well as non-renewal of maturing time deposits at the beginning of October, which have slowed but not yet reversed. Credit Suisse's liquidity coverage ratio, a measure of how well a bank is prepared to deal with sudden withdrawals, stood at an average of 192% at the end of the third quarter, one of the highest among European lenders. It dropped to 154% this month through Tuesday, with lower spot rates over this period that remain below this average through that date. And so notably what we see here is they should be able to buffer these withdrawals. This should be no big deal for Credit Suisse. The liquidity coverage ratio tells us, hey, this bank is solvent, but as it turns out, there's something that we're eventually going to find out about Credit Suisse that's much worse than we can imagine. Lenders are generally expected to maintain a ratio of 100%, though individual regulators can impose additional requirements which may come to Credit Suisse down the road. And as we found out, Credit Suisse plunges most ever after radical reboot disappoints as a bank takes a $4 billion overhaul and sends the stock price crashing. Amid stock dilution from coming share sale and prospect of just nominal dividends until 2025, the shares tumbled 19%, the biggest single-day decline on record. And this is something, that I think is coming at the bottom of the next recession is, you hear a lot of people say, well, I'm going to buy a lot of stock. That's what I really want to buy. But I think what people are missing out on is that companies are going to need cash. We look back, at least in the U.S., we see a lot of corporate share buybacks. And when are those occurring? At the top of the market. So when the bottom of the market gets in and these companies are hemorrhaging cash left and right, instead of having their cash buffer, which they use to buy their stock back, they're going to have to issue more shares, and that will put downward pressure on stocks. We're seeing it now with Credit Suisse, and look at how the market's reacting, and this is just the beginning. The need for something dramatic can be seen in the scale of the bank's fall. A $4 billion third quarter hit ensured that Credit Suisse's losses here will, get this, wipe out the profit it made over the past decade. That is huge. The firm's the market value dipped below $10 billion this month from $50 billion less than 5 years ago. And now, of course, it makes a case of why people are going to be dumping their stock when they see no prospect of future return and they see that just a small amount of withdrawals is hitting liquidity problems. There's definitely some rot underneath. The capital increase, equivalent to about 1/3 of Credit Suisse's market value, is an indication of the level of desperation. That is a key point, absolute desperation, as bank executives have wanted to avoid selling equity given the shares were trading near record lows, but outflows from wealth management clients forced their hand. So again, blame social media because, hey, if people would have said we're okay, we wouldn't have had this cash go out, we wouldn't have to start dumping shares, putting further downward pressure on their stock price, and that gives customers absolutely no confidence, and watch, more money will leave and more problems coming for Credit Suisse. But how about the U.S.? Are there problems facing here? Or perhaps things are looking pretty good? Well, maybe not as good as the headlines suggest. U.S. consumer spending rose in September as underlying inflation pressures firmed. This from the Wall Street Journal, as prices rose at a faster pace when excluding volatile food and energy costs, two key things consumers must spend money on. U.S. households increased their spending in September as their incomes rose. Sounds good news, suggesting that consumers are handling inflation, but not so quick. Consumer spending increased by a seasonally adjusted 0.6% last month, with households spending more on services such as transportation and rent. So you're going to hear this rent coming up repeatedly, and this is going to be an issue not only in the consumer price index, but in the personal consumption and expenditures index for the next few months, because this is something that's a very lagging indicator. We expect to see perhaps 2 or 3 more months of it, and then it's going to drop off as well. But the idea that the consumer is robust and healthy, the fact that they're having to spend more money on rent and transportation, what does that mean? Less money for? You got it. Discretionary goods and services at a time retailers and wholesalers are loaded up with inventory, and we're headed into the critical holiday season. Overall consumer prices rose 6.2% in September from a year earlier, the same pace as August. When stripped out of the volatile food and energy prices, the index strengthened. It went higher to 5.1% year over year from 4.9% in August, the strongest pace since March. And what does this mean? It means likely that people believe the Fed will continue to hike and be aggressive. But notably, I want to point out that this isn't always the case. When we look at personal consumption expenditures here in blue against the core PCE, which strips out food and energy, there are times where you can see that the core here in red is rising. And while the PCE itself isn't, the headline isn't really shooting higher, it can actually trend lower. There are times when the core goes down and the headline stays relatively flat. So the notion that the core here is going to drive headline PCE is not necessarily the case, particularly when we know one of the biggest drivers in it is rent, and we know from the headline that energy prices are having a major impact. Here you can see PCE in blue again overlaid against crude oil prices or West Texas Intermediate. And notably, we see in red energy prices headed lower. And we can see that there are times as you see energy prices trending down, the PCE eventually follows it. And as energy prices head higher, the PCE eventually trends higher with it. We know this time that, as I've said, is going to be an issue with inflation, is that on a year-over-year rate of change, energy prices are going to hit zero and then dip negative unless oil prices just shoot outright higher, and that's going to bring headline inflation, at least from the Fed's perspective. Now keep in mind, we look at the CPI, that's what the consumer gauge. The Fed is fixated on the PCE, that's still elevated, but notably it is trending lower, and that's the key. As energy prices head down on a year-over-year rate of change, so too will the PCE. Consumers' outlook for the U.S. economy deteriorated in October, not a surprise, after rising in August due to the Conference Board survey set on Tuesday. Consumers' expectations regarding the short-term outlook remain dismal. Again, this will be a huge problem as we head into the holiday season, and that inflationary pressures will continue to pose strong headwinds to consumer confidence and spending, which could result in a challenging holiday season. And there is a lot to this. We can actually should show that higher consumer prices actually do lead to lower consumer spending. And why is that? Well, the key reason is wages aren't keeping up with inflation, so that means consumers have to make a choice, and when made a choice, of course, we know that discretionary spending goes down. And here we can see in this chart of the consumer price index in blue against advanced retail sales in red, both on a year-over-year rate of change. There are periods as inflation is shooting higher that retail sales growth slows. We can see that happen several times. Even here, as inflation remains high but still slowed, we note that retail sales continue to slow down. Here we see inflation remaining very high, and that does not bode well, again, for the holiday season. As I've suggested, is super critical, because if we get to January and all these inventories do not come down, you're going to see massive, aggressive cutting that will be disinflationary, potentially in some parts of the economy, outright deflationary. I think the major pressure we're seeing here right now in terms of consumer spending on outdoor recreation is a pressure on discretionary spending capabilities. Bingo, nailed it, due to the higher food costs, gasoline costs, and other services that might be experiencing, according to the Winnebago CEO, and he's got it right. You know, we have to spend money on food, we have to spend money on energy, we have to spend money on shelter, and when prices of those go up and wages aren't going up enough, we cut other spending. But there is a bit of good news in the economy, at least I think perhaps through the middle of December, and that's on unemployment claims that remain historically low. U.S. jobless claims rose slightly last week as claims hovered near the pre-pandemic 2019 average. Initial claims, the proxy for layoff, rose slightly to 214,000 last week, but again remain historically low, suggesting a strong labor market. But not so quick. Continuing claims of people who are on unemployment managed to tick a little bit higher to 1.44 million from 1.38 million last week. They were reported with a 1-week lag, and indicating that while employers aren't getting rid of people as quickly as before, those who are on the unemployment line are having trouble finding jobs. My guess, my bet, is by mid-December, we'll start to see layoffs increase as employers are holding on to people, hoping for a robust holiday season. But when that doesn't come to fruition, look at them to cut in big ways. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.